Hey, good evening. I'm Brandon Moncrief with McLaren and Associates. Thanks for joining me and carving out hour to an hour and a half of your night tonight to talk about selling to a private buyer versus selling to a DSO. We're going to cover a lot of ground tonight. We're going to talk about current market conditions, both in the private buyer world and the DSO world. We'll talk about different transition strategies as they pertain to a private buyer sale versus a DSO sale. And with that, let's hop right in. A little bit about our company and myself. So my name's Brandon Moncrief. I'm the principal and CEO of McLaren. I have 22 years of experience in the dental industry. I spent about the first decade of my career as a banker, lending money to dentists all across the country to buy practices. I purchased McLaren and Associates about 12 years ago. And at that point in time, we were kind of a mom and pop shop, like you see a lot of the other dental practice brokerage firms out there, doing 15, 20 private buyer transactions a year. And over the past 12 years, we've grown considerably. We're now the largest practice brokerage firm in Texas from a doctor-to-doctor perspective. We close about 50 to 60 transactions a year in that world. And then we're an authority on DSO transactions nationwide. So we do sell-side advisory for large practice owners who are seeking to go down the DSO path or bring on a private equity partner for a number of different reasons, which we'll cover tonight. And that's the team that I lead on a daily basis. We've got a fantastic team of people behind us. We've got people from all aspects of the dental industry. My brother and business partner, Ryan Moncrief, is a former Patterson rep and had a successful career in marketing before that. We've got a former dentist on the team. We've got former bankers on the team like myself. And we have a former investment banker. He has an MBA from Wharton, a law degree from Penn. We brought him on board to help build out the DSO private equity side of our company. So now we do about 100 transactions a year. About half of those are doctor-to-doctor transactions, and half of them are DSO transactions all over the country. McLaren Associates has been around for 35 years. It was originally started by Paul McLaren in San Antonio. Paul was a practicing dentist for about 10 years, developed a hand disability, which forced him away from the chair. And at that point in time, he had to reinvent himself. He didn't want to leave dentistry. And he founded McLaren Associates as one of really the first practice brokerage firms in the country. As I said before, Paul owned the company for about 22, 23 years on his own. And about 12 years ago, I purchased the company, and a few years later, brought my brother in as my business partner. So we're now a team of 12. We have coverage all across the country. Most of us sit at our headquarters in Austin. We have an office in San Diego that Justin Klingshirn heads up, and we have an office in Atlanta that Jet Puckett heads up. So we actually have an employee in every time zone at the moment. We've closed over 1,000 successful practice sales, accounting for about $1.2 billion in closed transaction volume. As I said before, we specialize in providing practice brokerage and sell-side advisory. We do doctor-to-doctor transactions predominantly in Texas and the surrounding states. And then we do sell-side advisory for DSO affiliations nationwide. A little bit of housekeeping before we hop into the content. If you have a question tonight, you can text me on my cell phone. That number is listed here down at the bottom, 512-660-8505. Or in the bottom right hand of your screen, you can actually type a message, type a question, and hit send. And I'll do my best to get to all your questions tonight. I want to make sure that you get all your questions answered. You get everything you came to get out of this presentation. So again, appreciate you spending the next hour, hour and a half with me. We're going to cover a lot of ground, and I'm always available for follow-up after the webinar to take a phone call, go back and forth, email, text, a million different ways to get a hold of me. So if you see me checking my phone tonight, I'm not, checking Facebook or social media. I'm looking at your questions. All right, let's hop right into the content. So the first half of the webinar, I'm going to be focused primarily on talking about doctor-to-doctor transitions, private practice sales, and then I'll pivot about halfway through to talking about DSO transactions. And we're going to talk about, the pros and cons of each, how each of those transition strategies is different, because They are very, very different. So we'll start off talking about doctor-to-doctor practice transitions and current market conditions. Despite rising interest rates and despite a lot of people believing that, it's hard to get a loan to buy a practice or young doctors don't want to pursue practice ownership, we're seeing steady demand from private buyers in the marketplace. We're doing as many doctor-to-doctor practice sales as we've ever done. So that's good news for those of you that are going to look to transition your practice to a private buyer. We've actually seen demand and valuations for practices with revenue of, let's say, $750,000 or more increase substantially over the past few years. And that's primarily driven by the fact that doctors who want to buy practices, they're doing so because they want to acquire cash flow. They want immediate income as opposed to starting a practice from scratch, being in the red for a year or longer before they actually start to pull an income from that practice. So $750,000 in revenue to about $1.5 million in revenue. That's really the sweet spot where we see the most demand and the highest valuations in the doctor-to-doctor world. 100% financing is readily available. There's actually more banks lending money to dentists today than ever. And that's saying something because that's really the reason that I left dental lending about 12 years ago. It got insanely competitive to the point where, I wanted to go do something a little bit different, just play a different role in the same type of transaction. But it's as competitive or more competitive today than it was then. 100% financing, conventional loans, plus working capital, readily available. So we've got a handful of banks. We work regularly with about, 3 to 4 banks that fund the majority of our doctor-to-doctor transitions. We are dealing with rising interest rates, and that really hasn't impacted demand at all. I will say that buyers are doing more diligence. Their advisors are doing more diligence than ever. Rising interest rates, that does cut into cash flow because most of the buyers are borrowing 100% financing plus working capital. If you take interest rates and raise them from 3 or 4% up to 5 to 6%, it does make a meaningful difference in your monthly payment. So that's squeezing cash flow a little bit, and it's causing buyers and their advisors to lean in and ensure that they don't make a mistake, that they do their due diligence, and they understand after all the bills are paid, after the debt is paid, how much is the doctor going to be able to take home at the end of the day. Over the past few years, I will say that certain types of practices have gotten more difficult to sell. And those are offices that are either smaller or antiquated. So annual revenue under about $600,000, those practices have less demand than they did 4 or 5 years ago. Reason being, they just don't generate sufficient cash flow to be self-sufficient for a full-time practice owner. A lot of these kids that are coming out of dental school are coming out of dental school with average student loan debt of $300,000. They've got pretty big expectations, or their spouse has a pretty big expectation as to the type of lifestyle they're going to live. And as a result, they're chasing larger practices. So that's why we've seen demand rise for larger practices and fall for smaller practices. And most dental schools are utilizing state-of-the-art technology. They've got cone beams, they've got Cerix, they've got new ADEC equipment. So the kids that are going through school have an expectation that you're going to have that type of technology and newer technology and equipment in your office. Now, that doesn't mean if your office is antiquated that it can't be sold. It just means that you may not have as much demand, or it may not trade for as high of a valuation as a practice with similar cash flow that's fully updated. Less than 4 operatories is an issue these days, and that's because a lot of dentists aspire to have multi-doctor practices. There's been a huge push towards group practices over the past 5 to 10 years, and a lot of that's driven by the fact that dentists, they don't want to be an island unto themselves. The younger generation is more social than ever, and they want to practice alongside their colleagues. And because of rising overhead costs and pressure on pricing, group practices that have multiple doctors that produce at a much higher level are typically more profitable. So there's definitely a shift towards group practice having multiple providers under one roof. And if you have less than 4 or 5 operatories, it's hard to accomplish that. We talked about antiquated finishes and equipment and technology. So these are the types of practices that, really we've seen the most change in over the past few years, that are becoming harder to market, harder to sell. And we find ourselves, unfortunately, saying no more often when people call us and ask us to sell their practice if they're only doing, $300,000 or $400,000 a year, because we know how difficult it's going to be to move a practice of that size. So I just saw a question come in. Is there a sweet spot for annual net revenue rather than annual collections? So we look at revenue and collections as being synonymous with one another. When you talk about production is another animal, right? You have to produce a certain amount of dentistry to collect a certain amount of dentistry. In a fee-for-service practice, you're typically going to see that, production and collection are relatively tight. You're going to collect the majority of what you produce because you're billing out your full UCR. In a PPO practice, in order to hit $750,000 in revenue, you might have to produce $1 million in dentistry a year, because you're going to have significant write-offs. Anywhere from 20 to 35% of your UCR is going to be written down to the PPO reimbursement rate. So really the answer there, the sweet spot is about revenue. 700 to 750,000 and higher, all the way up to 1.5, maybe even 2 million. That's what most buyers, when they call our office, they say, "Hey, Brandon, I'm looking for a practice with 5+ operatories near a major metro area with annual revenue of 800,000 to 1.2 million." That's a really, really common conversation that Kristen, our buyer liaison, has on a daily basis. Key factors that drive value from a doctor-to-doctor perspective. There's two major benchmarks that buyers use when they look at valuation. So there's this age-old benchmark of practices trade for somewhere around 70% of revenue. Most of our offices trade somewhere in the range of 70 to 90% of annual revenue if they're being sold to a private party. Now, we're going to talk about valuations in the DSO world. They don't really go off percentage of revenue. In that world, it's more about a multiple of EBITDA. It's about a multiple of absentee owner cash flow. So in the private buyer world, you're typically going to max out definitely at 100% of revenue, with most practices trading in that 70 to 90% of revenue range. Net cash flow. Net cash flow basically means revenue minus overhead, how much money is available to pay the doctor and pay the debt. On average, practices net somewhere around 37 to 38%, and they typically trade for around 2 times net cash flow. So if your practice is netting 38% after overhead of 62%, and you're trading for 2 times net cash flow, you're trading for 75 to 78% of revenue. Practices that are more profitable obviously will trade for higher valuations, and practices that are more attractive in very attractive major metro areas, newer office, street visibility, 5+ ops, great technology, and solid cash flow, they're also going to trade, on the higher end of that 70 to 90% of revenue range. Other factors that impact value: patient mix. There's definitely a pecking order. So from a private buyer perspective, they love fee-for-service. They definitely understand that a lot of practices are going to have some exposure to PPOs, if not predominantly PPOs. But a lot of private buyers are averse to Medicaid and capitation. So that's the pecking order: fee-for-service, PPO, Medicaid, capitation. Procedural mix matters. The more expanded the seller's skill set, the harder that production is to replicate, and the smaller the buyer pool, as opposed to a bread and butter practice where it's predominantly crown and bridge, and most dentists can come in and mirror your skill set, larger buyer pool. So the procedural mix matters to some degree. If you're doing a lot of, heavy full arch cases, cosmetic cases, that's going to shrink your buyer pool, because there's only so many doctors out there that can mirror that skill set and have the personality to sell those types of cases. Locale matters. So rural versus urban. You absolutely are going to see a higher level of demand in urban environments, practices located within, let's say, 30 miles of a city center. You're going to see far more buyers than practices located in tertiary or rural markets. Now, the interesting thing is, most of the time, comparatively speaking, practices in rural markets have far better cash flow because overhead expenses are lower. Staff is paid lower, occupancy cost is lower, there's less competition. So those practices financially are engineered more favorably than practices located in an urban market, but they'll typically trade for a little bit lower percentage of revenue or multiple of cash flow because there just isn't as much demand. So if you're in a rural market, you're going to be selling your practice to a private buyer. You need to prepare for the fact that it could take longer to find that buyer and to close on the sale. I would say on average, our practices in urban markets will sell within 6 months easily, if not go under letter of intent within 4 to 6 weeks of hitting the market. In rural markets, it's very situational. We've sold practices very quickly in rural markets, but you need to be prepared that it could take 6 to 12 months, possibly longer, depending on your locale, to sell your practice if you're in a rural environment. High visibility versus limited or no visibility. So there's been a big push towards street visibility in dentistry to be in a high traffic location, primarily driven by the DSOs that are putting practices in retail centers. In reality, if you already have a large patient base, your fee-for-service PPO, high likelihood that patients aren't finding you by driving by your office. They're finding you through referrals. They're finding you through your online reputation. So it's our job to educate buyers that visibility would be ideal, but it's not an end all. You don't have to have a high visibility location in order to be successful in dentistry. If you buy an established practice, you've already got your built-in referral engine. You're already going to have new patients coming in the door if you're taking care of your existing patients. Quality of facility and equipment. We kind of hit on this earlier. Excuse me. Antiquated practices are definitely harder to sell. So the quality of your facility, the quality of your finish out, your equipment, your curb appeal definitely matters. You're going to get more demand. You're going to see more action on your practice if it's updated. And, for those of you that have antiquated practices, I mean, even investing $25,000, $30,000 in updating the flooring, the countertops, the paint, that's going to go a long way in increasing your curb appeal. If those new finishes are surrounded by older equipment, it's going to make your office look better and be more appealing, especially to young buyers. And then upside potential. Buyers are always looking at, what procedures are you referring out? Are you marketing? Do you have a strong online presence and reputation? What can they bring to the table to grow your revenue and grow your bottom line? So all of these factors determine how quickly your practice is going to sell, how many offers you're going to receive, how much demand you're going to see for your practice. And then on that sliding scale, 70 to 90% of revenue, where the practice is going to trade. So let's talk about 5 proven transition strategies from a doctor-to-doctor perspective. Sell and walk away. By far the simplest strategy that we deploy and the most common. Now, the reason being it's the most common is because a lot of doctors wait until the day they're ready to retire to call us. And by default, if you're ready to sell yesterday, then we're talking about a short-term transition. Sell and walk away. And a lot of people are like, how does that work? What does patient attrition look like when you sell a practice, especially a fee-for-service practice that, is personality driven and patient experience driven? What does the attrition look like when you sell your practice and walk away? The good news is that attrition is typically really, really low, so long as we find a buyer that's a good fit. And we work very, very hard to vet buyers and make sure that we pair them with the appropriate practice and the appropriate seller. So we do a lot of vetting on the front end, and then you have the opportunity to interview and vet, the buyer as they express interest in your practice. But we look at attrition from the patient perspective. So if I'm a patient and I receive a letter announcing that, you're selling your practice or transitioning your office and retiring, and you give a glowing endorsement of the new doctor, the likelihood is that I'm going to return to that practice unless I, used to live near the office. Now I live in a different state or 100 miles away and I'm driving in specifically to see you or your hygienist. Then I might go find another practice. But the reality is, most likely the patient is going to give the new owner the opportunity. And so long as the new owner, is a good fit and doesn't, hurt or piss off the patient at that initial visit, as long as the staff is still intact, the location's still intact, you still take their insurance, as long as the convenience factor is there, that patient's going to give that new doctor an opportunity. So most of the time, patient attrition is really, really low, maybe 10, 15%, so long as the transition is handled properly. And that 10 to 15% attrition is going to be made up by the fact that the buyer is going to come to the practice with new energy and their own network of friends and family and community that they're going to replace the patients that leave with their own patients. So this is by far the most common transition strategy that we utilize. I will say that when I came into this business 12 years ago, the sell and stay on an associate was far more popular, but because young buyers have a lot of debt and high lifestyle expectations, and they've heard some horror stories from their colleagues about what it was like to buy a practice and have, the previous owner still present on a daily basis and how that can potentially disrupt or undermine the transition. A lot of them are requesting that, they have more of a clean break, more of a walkaway sale. They need all the dentistry for themselves. They need all the production. They need all the cash flow for themselves. And sometimes it can be awkward for the seller to be there post-closing. So that brings us to the next strategy, and that's sell and stay on as an associate. I will say that if that's the strategy we're going to deploy for you, it's a huge shift in mentality. Predominantly from an emotional perspective, to sell your baby and then stay on and continue to work as an associate in your practice post-sale with the new buyer, at the helm. There's going to be some change inevitably in your practice when you sell to a private buyer. There might be, typically they're going to retain all the staff, but not all personalities mesh. They're going to want to update the technology. They're going to want to go paperless if you're not paperless. They might want to remodel the office or update the equipment. So there's going to be some change. And it's kind of funny. We've actually had, I won't say it's funny, but we've had sellers freak out post-close when they've stayed on as an associate. I remember this vividly, but I got a phone call from a seller. We closed on a Friday. They called on a Monday, and they were irate, extremely distraught emotionally. They walked into the office. They were staying on post-sale. They walked in on Monday morning, and over the weekend, the buyer had changed out all the furniture in the reception area and painted it and changed the curtains. The seller completely freaked out. And it wasn't because they didn't like the color of paint or they didn't like the new furniture. It was because that's the moment that they realized they were no longer in control. So it's a big shift in mentality to go from being an owner for 20, 30, 40 years to being an associate in your own office. So if that's the transition strategy that you're going to deploy, then you need to make sure that you're comfortable with that emotional shift. So in a lot of cases, especially larger practices, the seller will sell the practice to the incoming buyer. Incoming buyer will come in and work full-time or part-time along with the seller, staying on typically part-time for some period of time. Maximum work back that we see in a private buyer sale is typically a year. I think you need to be prepared for the fact that a private buyer might tell you that they need you and they want you to stay on post-close, but once they get their feet underneath them, if they're comfortable producing all of the dentistry, if you're at the chair doing a crown and they're in the office playing solitaire, the writing's on the wall that, you're probably going to be asked to sail off into the sunset sooner rather than later because that young doctor needs that production. They've got a lot of student loan debt. They've got high lifestyle expectations, and they just paid you a lot of money and borrowed a lot of money to buy your practice. So they need all the production they can get. Moving on, let's talk about associate to purchase. So this is a transition strategy that we deploy when we have a seller with a larger, very attractive office that wants to cut back, but isn't ready to turn over ownership yet. They're within a year or two of wanting to sell the practice outright, but their preference is to onboard an associate that's eventually going to become their buyer, and they're going to cut back their work schedule and work part-time for a couple of years before they sell the practice to that associate. That associate steps into the ownership role, and the seller steps into the associate role. And in this scenario, if we're going to utilize this transition strategy, what we advise our clients to do is let's set all of the rules of the game up front. Let's establish the valuation, the purchase price up front, or a formula for calculating the purchase price. Let's establish the future close date, typically a year or two into the future. And then let's talk about how the relationship's going to function from the point that that associate joins the practice to sale and post-sale. So in other words, we want to say, hey, we're going to sell the practice for $900,000 2 years from now. Seller's currently working 4 days a week. At the time the associate/buyer joins the practice, seller's going to cut back to 2 days a week. Associate's going to join 2 days a week. And they're going to work together in that relationship up until the point of close. And then they're going to reverse roles. And hopefully the practice has grown in the interim. The associate/buyer can join the practice full-time, and the seller can stay on part-time. We typically enter into a letter of intent at the time the associate joins the practice. It's non-binding, but we're going to agree on all the things I just outlined. And then there's a honeymoon period typically of, let's say, 3 to 6 months, where either party, the associate/buyer or the seller, can back out of the relationship before the honeymoon period concludes. Both parties look at each other and say, hey, this is a good fit. You want to move forward? Yes. You want to move forward? Yes. At that point in time, about 3 to 6 months into the relationship, we will enter into legally binding purchase agreements, mirroring the terms that we agreed to in the letter of intent. And then the relationship will continue as outlined for the next 6 to 18 months until the sale occurs. So it makes the process as predictable as possible, rather than saying, hey, I want to hire an associate and sell them my practice in a couple of years. You don't discuss any of the specifics on the front end, and you attract the doctor to your practice. Everybody seems to be on the same page, but then 2 years go by, you're ready to sell and the associate's not ready to buy. Or you have different ideas about what the practice is worth. Or associates chomping at the bit ready to buy, and you're not ready to sell. So we want to make the process as predictable as possible by outlining the game plan up front. Moving on, partnership. A partnership is a tool in the toolbox, but it's certainly not the first tool that I reach for when we're talking about transition strategies. I believe that a partnership really only works if the doctors are around the same age, at the same point in their career, and they know each other well. I don't love utilizing a partnership transition strategy when we're talking about a 60-year-old doctor and a 30-year-old, associate that's going to buy into the practice, unless they're planning on practicing together long-term. And the reason we don't use the partnership transition strategy frequently is because if you're at very different stages in your life and your career, you have very different ideas about what you want to accomplish in practice. Typically, if you're 60, 65 years old, you're 30 years into your career and ownership, you should be kind of on cruise control, right? Everything's kind of dialed in. You don't want to change a lot. Everything's going well. Whereas if you're a young doc with a lot of debt and big aspirations, you're going to want to hit it hard. You might want to market. You might want to buy new equipment, upgrade technology, upgrade the office, upgrade the facility, spend money that the older partner may not be down to spend this close to their exit from the practice. So if you're going to do a partnership, it needs to be a long-term arrangement, at least 10 years. And my preference is that the parties are, near the same stage in their career in order to become partners. And you need to have a fantastic partnership agreement. So you're going to need to have a great dental attorney draft a partnership agreement that talks about everything that can go wrong, right? Divorce, depression, partnership disputes, substance abuse, whatever it may be. You're going to have to talk about what happens if the relationship gets difficult. And oftentimes, as those conversations occur, the people realize that they don't want to be in a partnership, that, maybe it's best that they wait until they're ready to do an associate to purchase or an outright sale. Finally, sunsetting your practice. So for a lot of doctors, this is an unintentional transition strategy, but we often get calls from docs that say, hey, I've got a 4-op office. I'm doing $300,000 or $400,000 a year. I was doing $800,000 a year 5 years ago, but I've cut back. Maybe, I had a health issue, whatever it may be. But the practice revenue has declined substantially leading up to the point that they make that call to us. And subsequently, the cash flow has declined substantially. I mean, as we all know, overhead typically doesn't go down over time. It goes up. So if we've got revenue going down and overhead going up, it's squeezing that net cash flow and it's diluting the value of the practice and the marketability of the practice. So if your game plan is to cut back significantly and ride it out over a few years before you sell, just understand that consciously you may be utilizing the sunset strategy, and there may not be a buyer for you at the point that you're ready to exit your practice and sell. Now, you had the benefit both emotionally and financially for practicing longer into your career. So if you had a $600,000 revenue practice and you were netting $200,000 a year and you could have sold your practice 3 years prior for $450,000 or $500,000, but you chose not to, and you chose to sunset your practice and make another $450,000 or $500,000 over the 3 years before your retirement, before a sale, you essentially net had the same benefit, financially, but emotionally, you weren't ready to retire. You weren't ready to leave your practice. So you got to fulfill that requirement. So sunsetting your practice, if you're going to do it, I prefer that you do it consciously rather than unconsciously. And we have to have, a difficult discussion when you call and you're ready to sell. I would prefer to have as few of those discussions as possible. Again, just a reminder, if you have a question, text me on my cell, or you can type a message in the bottom right-hand corner and hit send. All right, so that wraps up the doctor-to-doctor portion of the presentation. I'll still reference it as we talk about DSO transactions. I did have a couple of questions come in that I want to address. So one of the questions was, what does our firm charge for a doctor-to-doctor practice sale? So in the doctor-to-doctor world, we typically start off with a valuation. Let's quantify the cash flow. Let's quantify what the practice is worth in the open market. We typically charge $1,500 for a valuation from a doctor-to-doctor perspective. And then at the point of sale, if and when we sell the practice, we charge anywhere, from 8 to 9% of the sales price of the practice. And that's going to depend on the size of the office. It's going to depend on the marketability of the office. So the valuation, $1,500 standalone engagement. Our typical commission on an average doctor-to-doctor practice sale is 9%. Most brokers out there tend to charge 10%. So we're slightly lower than I would say the industry average, and we do a hell of a job compared to our peers, which is why we have a 5-star reputation on Google. And I encourage you to check out our Google reviews, over 100 5-star Google reviews from real life clients. So let's pivot. Let's pivot to talking about DSO transactions. So we have half our team dedicated to doctor-to-doctor practice sales. I lead the team that's dedicated to DSO and private equity transactions. These are obviously larger practices all over the country that are looking at, going down the DSO path. So current market conditions in the DSO private equity world. Private equity has a tremendous amount of dry powder, a tremendous amount of cash. Capitalism is really set up, maybe inadvertently, so that the rich tend to get richer. And as wealthy individuals need to balance their investment portfolios, they put money in stocks, they put money in bonds, and they typically put money in alternative investments. Private equity is essentially alternative investments. It's privately held companies that individual investors have the opportunity to invest in via a private equity firm or a family office that deploys that capital in stable, highly profitable, fragmented industries like dentistry. So private equity has a ton of cash available to spend in many different verticals. This consolidation that's occurring in the dental industry today has been occurring in many other verticals, veterinary medicine, med spas, heating and air, landscaping companies. There's all different types of companies that private equity invest in. We're just seeing it heavily in the dental space over the past 5 to 7 years. So back to wealthy individuals building a portfolio and needing to keep a balanced portfolio. The reason that so much money has flown into private equity is because the stock market has went bonkers, over the past decade. And as a result of the equity you have in stock markets increasing in value, you've got to rebalance that portfolio and push more and more money into alternative investments into private equity. So it's pushed a tremendous amount of capital into private equity, and they're looking for solid industries to deploy it in. Pre-COVID, private equity was already heavily interested in the dental industry. There were 150 to 200 DSOs operating nationally pre-COVID. Dentistry rebounded as fast or faster than any other industry, particularly any other medical vertical, which private equity loves, coming out of the pandemic shutdown. So when private equity was already interested in dentistry, a lot of them were already in the space. Many of them were eyeing the space. When they saw how quickly it recovered post-COVID, it pushed even more capital into the dental industry. The private equity firms, the DSOs that were already in, doubled down and began to buy practices at an even faster clip. And then new private equity firms came into the industry and made an investment and are now building DSOs. So pre-COVID, we had 150 to 200 DSOs. Now we have somewhere in the range of 400 to 500 DSOs. So it's incredible how much investment there's been in our industry from private equity. I want to pause for a minute and talk about why our company got involved in the DSO and private equity space. So we built our company for the first 28 to 30 years. We were focused on doing doctor-to-doctor practice sales. That is the backbone of our business. And as I said before, we still do a ton of them. We still do 50 to 60 private practice sales a year. Texas and several other states were on the forefront of the DSO consolidation. We started seeing a lot of our large practice owners that we thought were going to wait until they were ready to retire and sell to a private buyer, decide to sell to a DSO, oftentimes prematurely, without a proper education about what options were out there, how private equity views value. They didn't know what their EBITDA was. All they saw was that Heartland or some other DSO was willing to pay 100% of revenue, a 20% premium comparative to selling to a private buyer. And what we started to realize is private equity has really deep pockets and was willing to pay a lot more than what these doctors were selling for. And the doctors also just sold to the first DSO that walked in their door. They had no optionality. So we decided, hey, we've got to get involved, right? We're finance guys. We're former bankers. We've got to build out a process to provide a high-level education to large practice owners so they don't make mistakes, so they don't leave money on the table, so they don't leave prematurely. So we were essentially forced into the business of representing large practice owners and getting educated about the DSO space and then educating practice owners about the same. So about 5 years ago, I spent the better part of 18 months getting educated on the private equity space and the DSO space, traveling around the country, meeting with executives from DSOs, learning about their deal structure, kind of learning who's who in the zoo, right? Who had the operational pedigree and the financial backing to be successful long-term. And then building out a process for providing high-level sell-side advisory to large practice owners to ensure that they have the optionality and the leverage to find the right fit if and when they go to market and maximize their economic outcome from the sale. So that's why we got involved in the DSO private equity side of the space. And I'm glad we did, because we've done some amazing things for practice owners that had they tried to navigate those waters on their own, they likely would have made a tremendous amount of mistakes, some of which we'll talk about later. But they inevitably would have left a lot of economics, a lot of money on the table. So we talked about why private equity loves the dental industry. So let's talk about why DSOs are not so much a four-letter word to practice owners these days. Up until about 5 years ago, I wouldn't even bring up the DSO topic to a lot of our clients for fear that they would, cuss me out or, run me out of their office. DSOs had a bad moniker. And I think that's because DSO 1.0, the initial version of DSOs in the 80s and 90s, it was doc in the box, clinic style dentistry. Most of them were de novo models. They started practices from scratch. They didn't buy or acquire practices. And, they would fool a patient with, an offer to do a free cleaning or a $99 cleaning, get them in the door, and then give them a $10,000 treatment plan. There were production quotas. It was just cringeworthy, I'd say. So the moniker that DSOs had for the first, 15 to 20 years that they existed was well-deserved. But the DSOs of today, the DSOs that acquire practices, have learned to stay in their lane. They offer pretty much pure clinical autonomy and a lot of operational autonomy. They partner with good doctors, they partner with good practices, and they essentially try not to screw them up. They can leverage economies of scale behind the veil. They can buy dental supplies for a fraction of what you pay for them. They can leverage their size with labs to get more preferential pricing. They can leverage their size with, healthcare benefit companies to save money on, health insurance. And they can leverage their size with payers to get higher reimbursement rates than private practice owners can. So behind the veil, just by leveraging their economies of scale, they can move the needle from an EBITDA and a cash flow perspective. They don't have to make major changes to the practice in order to accomplish their financial goals. So the DSOs of today have learned to stay in their lane, to support practice owners from an administrative perspective and stay out of the operatory. And for that reason, that's the primary reasons that DSOs really, no longer have that bad moniker. DSOs have also invited dentists to participate in the financial arbitrage being realized by private equity investors. So in most cases, private equity is buying practices for anywhere from 6 to 9 times EBITDA. And when they go to sell their DSO, their larger entity, to the next investor, to another private equity firm, or eventually the public markets as they grow in size, they're going to trade for anywhere between 13 to 15 times EBITDA. So there's immediate arbitrage to be had through leveraging economies of scale and selling a larger entity to an investor rather than a single practice. So they don't have to force change among their partners in order to elicit a financial return. And they've allowed practice owners to invest alongside them. In most DSO transactions, the sale price is going to be bifurcated into cash at close. That's going to be somewhere in the range of 60 to 80% of the value of the practice. And then some sort of equity component, whether that's retained equity at the practice level or a stock investment in the holding company of the DSO. And you have the opportunity to liquidate both forms of equity at a recapitalization event. Recapitalize means when the DSO's investor sells it to the next investor, you have a liquidity event. You have the opportunity to liquidate your equity in part or in full, hopefully at a handsome return. And those returns can be anywhere from 3 to 7 times your initial investment. So from a risk reward perspective, there's not better places to put your money, right? And that's why so many wealthy individuals invest via private equity. Dentists now have the opportunity to play in that sandbox because you have what private equity wants. They want to invest in dental practices. Therefore, they're inviting you to the party. They're inviting you to have the opportunity to invest alongside them and realize those returns that most of you otherwise would not have the opportunity to participate in, because private equity is typically limited to very, very high net worth individuals. Now, some of you on this call may have a net worth that would allow you to participate in investing in private equity investments. But for most of us, We'll never get the invitation to that party unless PE wants to invest in the business that we own. A big driver, obviously, that's pushing many large practice owners to consider going down the DSO path rather than sell to a private buyer is that DSOs pay significantly higher practice valuations. Now, earlier I mentioned that, the early DSOs that were buying practices like Heartland were paying, 100% of revenue, and doctors thought that was amazing, that they could achieve a 20% premium. Today, DSOs are paying anywhere from 6 to 9 times, sometimes 10 times EBITDA, and that can equate to as high as 200 to 300% of revenue, especially if we're talking about a large practice. That's a massive delta compared to a private buyer. So let's look at an example. So a practice with revenue of $2 million, it's going to have an EBITDA margin of around 20%. So let's say that they're running at a 25% margin. That would be, a $500,000, margin. So EBITDA, let's just break that down real quick because a lot of people are like, what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Essentially, what EBITDA means is absentee owner profit, right? How much profit is available to the investor, to the owners of the business once you take revenue minus overhead, real overhead. We're going to remove any non-cash expenses like depreciation, amortization. We're going to remove interest expense. We're going to remove any non-recurring or personal or discretionary expenses. We're going to take revenue minus real overhead minus doctor compensation. What would you have to pay a doctor to produce that level of dentistry in that office? That's essentially an overhead expense of the business for an absentee owner. See, revenue minus overhead minus doctor compensation equals EBITDA. DSOs view value through the lens of a multiple of EBITDA. So they're going to take EBITDA and they're going to apply a multiplier somewhere in the 6 to 10x range. So if we take a practice with $2 million in revenue in the private buyer world, it's going to sell for somewhere around 1.5 max, probably 1.8 million. In the DSO world, if its EBITDA is 500,000, it could sell for as high as 3.5 on a good day, $4 million, over 2 times what it would sell for in the private buyer world. Look, that's compelling for a lot of practice owners. When we're talking about a delta of, $2-3 million compared to selling to a private buyer, that gets your attention. The other thing that's driving people to look at selling to a DSO is the increase in burden of management. The burden of management has increased exponentially over the past 10 years. We've got a lot of PPO infiltration. We've got downward pressure on pricing. We've got upward pressure on overhead. We've got a lot of HR issues. We've got heavy pressure from an overhead perspective in the form of increasing staff costs, especially post-COVID. Finding good people, keeping them and compensating them is a daily struggle for most practices. And especially if you have a large practice, if you employ 20, 30 staff members, that's a lot to deal with. It's a lot to deal with financially. It's a lot to deal with emotionally, managing all of their expectations and personalities. So a lot of doctors are experiencing burnout. They might still love chairside dentistry, but they don't love the burden of management. They don't love the financial responsibility. They don't love having a lot of debt. And they don't love dealing with the daily headaches, especially from an administrative perspective, that it takes to be a successful practice owner. You have to be far more dynamic from a business perspective today to be successful as a private practice owner than you did 20 or 30 years ago. So because that burden of management has increased exponentially, a lot of doctors are looking to sell or partner with a DSO to offload some of that administrative burden and to de-risk, to take some chips off the table at a favorable valuation, protect that nest egg, invest alongside private equity, and have that upside arbitrage opportunity on the stock or joint venture equity, and then get some help from an administrative perspective. So it's a combination typically with most of our clients as to why they're selling. A lot of it's economic, and a lot of people are also trying to lighten their load to some degree. So I had a great question come in. Can you define DSO versus IDSO? There's no distinction, okay? So IDSO stands for Invisible DSO. It was a moniker that was made up by a couple of brokers, and it's used by a handful of DSOs. You'll hear DPO, Dental Partnership Organization, used out there. You'll hear all kinds of different acronyms that DSOs use to describe themselves. It's semantics. This is just me shooting you straight. It's semantics. They're all similar, okay? They all have a similar goal. They're all backed typically by private equity or a family office or some sort of investor, typically some sort of institutional investor, and they're trying to create financial arbitrage. They're trying to create a financial return. IDSO was created to give people the perception that they're different than a DSO because they're not going to change anything. They're going to be in the background. They're not going to rebrand your practice. They're not going to tell you how to practice dentistry. There's not going to be production quotas. They're not going to command that you work a certain number of days a week or a month or a year. They're really not going to tell you what to do on a daily basis. What I will tell you is whether it's an IDSO or a DSO, if they're in the business of acquiring practices, they're in the business of partnering with good practices and good doctors and not screwing them up. None of the DSOs that we work with, whether they refer to themselves as DSOs, DPOs, IDSOs, none of them are going to rebrand your practice. None of them are going to force a tremendous amount of change upon you. They're going to allow you to keep clinical autonomy. They're going to allow you to keep a lot of operational autonomy. Most of them take the position that, hey, we're going to leverage our economies of scale to help increase margins. Outside of that, you tell us what you need help with, and we've got the resources to make it happen. So there's really no difference between a DSO, an IDSO, a DPO, or whatever else, a DSO is going to call themselves. But that's a great question. I really appreciate it. Keep the questions coming. The more interactive this can be, I think the more everybody will learn. So let's get back to talking about current market conditions. Practice valuations have increased substantially post-COVID. So practices that were trading for, 5 to 6 times EBITDA pre-COVID, currently trading for, 6, 7, 8 times EBITDA. So practices are trading for at least a turn of EBITDA higher than they were pre-COVID, driven by some of the factors we talked about previously. It's driven by the fact that there's more buyers than ever, there's more demand than ever, combined with the fact that dentistry is proven to be pandemic-proof, recession-proof, and as a result, investors are willing to pay more. So it's been great to see practice valuations increase. We thought that 2023 could be a difficult year because we've had rising interest rates and we've had capital constraints from a banking perspective. A lot of regional banks that fund private equity and venture capital have pulled back substantially due to the impact of some of the regional banks that failed. But despite that, despite rising interest rates, despite tightening in the capital markets, valuations have remained very, very steady. So 2023, we thought was going to be a difficult year, but we've seen more M&A activity than ever. And valuations have remained, very, very steady post-COVID. So that's good news to anybody that's currently considering selling your practice. There is a narrative out there that DSOs are trying to put into the marketplace that valuations have substantially decreased. That has not been the reality that we've seen. So do not buy into that narrative. If you've got a great practice, if you create optionality, if you create demand, if you hold their feet to the fire and don't respond to an unsolicited offer, don't sell to a particular DSO just because your buddy did. If you could not fall for that trap, you're going to achieve an all-time high valuation in today's marketplace. That said, there are a handful of DSOs, I would say as much as maybe a quarter of the marketplace, that are on hold. They've grown too quickly. Post-COVID, they've added 100, 200 offices, and they've kind of gotten over their skis operationally. They need to catch their breath. They need to catch up from an infrastructure standpoint so that they can integrate and operate the practices that they've acquired long-term. So I'd say the quarter of the DSOs out there are currently on the sidelines, not buying practices. They're either re-engineering themselves operationally to set themselves up for long-term sustainability, or they're looking for new banking partners, looking for a new private equity partner so that they then have the financial wherewithal and the cash to be able to buy practices again. While those DSOs are on hold, simultaneously, we've seen a lot of emerging DSOs, smaller DSOs that have taken on private equity capital over the past couple of years and are still flush with cash. So while some DSOs have gone on hold and are not buying practices, these smaller to medium-sized DSOs that have taken on private equity investments recently are flush with cash and have stepped up to fill that void. That's why we have not seen a drop in demand, and it's why we have not seen a drop in valuations. We mentioned before there's over 300 DSOs operating nationwide. I think that number is probably closer to 400 or 500 now. I heard the other day that there's over 250 DSOs operating in Texas alone, which is a crazy number. So the consolidation is happening at an incredible rate. At the same time, we often see other brokers, some charlatans of the industry, try to put the narrative out there that private practice is dying and you've got to sell today because this window of opportunity is going to go away within the next 12 or 24 months. As I said before, we do 50 to 60 private practice sales a year, more than we've ever done. There's practices being started by young doctors and bought by young doctors on a daily basis. So while we do see daily practices being sold to DSOs, there's a young generation of dentists that is starting and buying practices and keeping private practice alive. So we don't think private practice is, going to suffer a quick death. We think private practice is still a great place to be and thriving. But you've got to be more dynamic. You've got to be more intentional. You've got to be more engaged from a business perspective to do well long-term as a private practice owner. And you need to pay close attention to the trends in the DSO world. And in some ways, you may want to mimic some of those trends in your own practice so that you can remain competitive long-term. At the same time, it is compelling if you've got a large practice with revenue of $1.5 to $2 million to at least explore the DSO option and see if it's the right fit for your practice, the right fit for your situation. So we've talked about rising interest rates. We've talked about recessionary fears and the regional banking crisis. DSOs are being tested right now from an operational perspective. And as a result, they're being more selective about the practices that they're acquiring. So they're not bidding on as many practices, but when they bid, they're bidding at all-time high valuations. That's what we currently are seeing. I think I saw a question come in. So the comment that came in was that they had received an offer from a DSO unsolicited, and they didn't feel that that offer was high enough. So now they're waiting on an offer from a secondary DSO. Yeah, what I will tell you is the reason that we exist and the reason that we have happy clients is that we bring value to every process we enter. If you respond to an unsolicited offer, if you're not working with a sell-side advisor like us, if you don't have proper representation, if you don't create optionality, if you don't create competition for your practice, no doubt you are leaving money on the table, and you're also risking that you sell to the wrong DSO. You've got to define your why, and that's going to determine who you sell to and what deal structure you take. So that brings us to this slide. It's a good entry. Why sell to a DSO? Every conversation that I have with the potential seller, the first question I ask, I typically say, tell me a little bit about your practice, and then tell me why you're exploring going down the DSO path. Is it economic? Are you looking to improve the work-life balance? Are you looking for administrative support? You've got to define your why in order to determine if it makes sense to pursue a DSO affiliation. And then when you go to market, that is going to be the first question that every DSO asks you. Why are we here? What are you looking to accomplish? What can I do for you? Is it economic? Is it administrative? I need to know your why so I can determine if I'm a good fit for your particular practice in your particular situation. So we already talked about the fact that there is typically, with a large practice, a massive delta between selling to a private buyer versus selling to a DSO. I think we've talked through that in detail. A lot of our clients are selling to de-risk. their practice is their most valuable asset. They've got a tremendous amount of their net worth tied up in their business, and they want to take some chips off the table and protect it, because tomorrow's not promised. We have no idea, what the macroeconomic conditions are going to look like, and they play a major role in the private equity markets and the public markets and, practice valuation. So a lot of our clients are saying, hey, I want to de-risk. I want to liquidate a portion of my business, and I want to protect that nest egg. At the same time, I want to invest alongside the DSO and participate in those future recap events. If I were to sell 100% of the practice and cash it all out, I've got to put the money somewhere. From a risk reward perspective, betting on the DSO that you partner with is, a good investment, so long as you partner with a good DSO that's got the financial and operational wherewithal to accomplish their financial goals. And they're not all created equal. If you've met one DSO, you've met one DSO. They're all engineered differently financially. They all have a different deal structure. They all have a different financial private equity sponsor. They're all at a different stage in their life cycle, not only with their size, but also in their current recap cycle. A recap cycle is typically 3 to 5 years long. So where you enter that cycle is going to determine how long you have to wait before you have a liquidity event. And it could also determine how robust your return is going to be at that liquidity event. Depending on the deal structure, if you enter early cycle, you may see a more robust return on your equity, as opposed to if you enter late cycle. If you enter 4 years into a 5-year recap and you only have to wait a year to hit that recap event, you're going to have a muted return as compared to the doctor that invested in that DSO 4 years prior. So de-risking, taking chips off the table, a higher valuation the private buyer is going to offer, improving your work-life balance through alleviating your management burden. Those are all the reasons that most of our clients look to sell to a DSO. But you've got to clearly define your why in order to evaluate whether it makes sense for you to pursue a DSO affiliation. And that's always where we start with our clients, is getting to know you and your practice intimately and defining your why. What are DSOs looking for? All types of practices. So for a long time, DSOs were really focused on buying general dentistry practices. Now we've got DSOs that are looking for general dentistry practices and then all specialties. I would argue that at the moment, OMS and ortho are probably the hottest verticals where we're seeing the highest level of demand and valuations. We have general DSOs now that are pivoting to go multi-specialty in the geographies where they have density, and they're starting to buy specialty practices. And then we have multi-specialty or specialty-specific DSOs. So in today's marketplace, there's really a lid for every pot. Most DSOs are looking for practices located within a 60-mile radius of a major metro area. Now, that doesn't mean if you've got a practice located in a tertiary market or a rural market, it can't be sold. It just means that there might be less demand and a slightly lower valuation, slightly lower EBITDA multiple. The reason that DSOs typically look for practices near metro areas is twofold. One, they tend to want to build out density within a geographic reason, geographic footprint. So if they buy a practice in a tertiary market, or that's far away from a major metro area, it's very difficult for them to buy a number of practices within a close proximity to that rural office. But if they plant a flag in a major metro area, there's a huge amount of inventory to choose from as they grow out their footprint in that geography. The other reason is recruiting. Both doctor and staff recruiting can be challenging in a rural environment. So in a metro area, it's easier for them to recruit doctors and staff. TTM revenue. What does TTM stand for? TTM stands for trailing 12 months revenue. Your most recent 12 months of numbers are your most important. And most DSOs, in order to get excited about a practice, they want to see $300,000 in EBITDA or higher. So $300,000 in absentee owner profit or higher. In order to generate $300,000 in EBITDA, your practice typically needs to be collecting 1.4, 1.5 million or more. Most successful practices are running at a 20% to 25% EBITDA margin. So if you back into the math, in order to generate $300,000 in EBITDA, you've got to generate about 1.5 million in revenue. Minimum of 5 operatories. DSOs pay very close attention to key man risk. And the way to mitigate key man risk is to have multiple providers at each of your offices. So most DSOs would prefer that you've at least got the facility to accommodate 2 doctors. They'll buy a 1-doctor practice. They would prefer to buy multi-doctor practices, but they will absolutely buy a 1-doctor practice. I would say, maybe a quarter of the practices we sell to DSOs are 1-doctor offices, but they are going to want to eventually add an associate, a second doctor. And if you have less than 5 operatories, unless you're getting really, really creative with scheduling, it's hard to accommodate, more than one provider from a facility perspective. And this is one of the main ways that a DSO varies as far as what they're looking for from a private buyer. Selling and walking away in a DSO scenario is very, very difficult to do. If you want to sell to a DSO and walk away at sale, you're going to have very limited demand, and no doubt you're going to take a hit from a valuation perspective. DSOs understand that doctor turnover, especially founder turnover, is their Achilles heel. So they're going to want you to continue to work 3 to 5 years post-sale. It used to be 2 or 3 years post-sale, but DSOs have learned the hard way that doctor turnover impacts practices adversely. So they've extended that timeline to 3 to 5 years, ideally 5 years. That's kind of the industry norm these days. So it went from requiring you to stay on for 2 to 3 years to 5 years in order to maximize the valuation. But here's the big difference. Here's one thing that's changed dramatically. When it was a 2 to 3 year post-closing commitment, DSOs required that you work a certain number of days a month or a week or a year, and that you produce at a certain level. The DSOs of today, while they've extended that post-closing commitment, they actually don't require that you work chairside at all. You have the autonomy to backfill your production with associates. So long as the practice continues to perform at a high level, they just want you to have some skin in the game, some sort of vested interest at the local level, so that they have a local operating partner that is going to be a good shepherd of the business and assure that the revenue of the practice, the profitability of the practice is maintained long term. So you're going to see a longer post-closing commitment, but they're far more flexible than they were previously in regards to your chairside responsibilities. Question came in. You said 1.5 million in revenue. That's what you need in order to be a target for a DSO. I would say the baseline is kind of 1.2 million as far as being a target for a DSO. 1.5 plus is ideal. You really start to ratchet up the economics, and the DSO valuation starts to run away from the private buyer valuation in a major way once you start to cross 1.8 to $2 million in revenue. But we've sold plenty of practices doing 1.2 to 1.3 million to DSOs. You're just not going to see, the crazy EBITDA multiples, the crazy percentages of revenue when we're talking about a practice on the lower end of the scale versus a practice that's doing $3, $4, $5 million in revenue and $1 million plus in EBITDA. Another question that was asked, we already answered it. How long do DSOs require that you stay on post-close? So let's talk about practice valuations from a DSO perspective. We kind of already hit on most of these points, but I'll hit them again. A healthy EBITDA margin. So healthy practices that are doing 1.5 million in revenue or higher typically operate at a 20 to 25% EBITDA margin. So your net, after real overhead and compensating a doctor a fair market wage for producing the dentistry that's being done in that office, a healthy net, once that overhead is paid, is 20 to 25%. Practices with EBITDA of less than $1 million typically sell in the 6 to 8 times EBITDA range. Once you cross that magic $1 million mark in EBITDA, and that's going to be a large practice, right? That's going to be probably $3.5 to $4 million in revenue or higher. You start to ratchet up the EBITDA multiple, and you start to ratchet up demand. So the level of EBITDA will impact the EBITDA multiple and impact the valuation to a large degree. Oftentimes people get fixated on the multiple. I feel like people want to go to like the Dykema DSO conference and stand around the water cooler and brag. I got 7x for my practice. I got 8 times EBITDA for my practice. I got 9 times EBITDA. The EBITDA multiple matters, but the EBITDA matters far more than the multiple. Every dollar of profit, every dollar of EBITDA is worth somewhere in the range of $6 to $10 in value. A big part of what we do is control the narrative regarding EBITDA. DSOs love to play games with EBITDA. They love to tell doctors that their EBITDA is lower than it actually is. You do not want your buyer educating you on what your EBITDA is. You do not want your buyer controlling the narrative regarding EBITDA and regarding valuation. Because what we often see is that we have a client that's talking to a DSO before they meet us, and they already have an offer on the table at the time they engage us. And we say, hey, call a timeout. And I'll mention right now, I'd say 70% of our clients are already talking to a DSO before the client engages us. And that's because they've built huge marketing machines, right? They've got big business development teams. They got big marketing budgets. They send a ton of direct mail to your office. They're asking the doctors within their network to refer their colleagues, and they're paying them a referral fee to do so. So if your buddy calls you up and says, hey, I sold to this DSO, you should sell to this DSO, they're awesome. Now, they might be, being truthful, but at the same time, understand that they're likely receiving some type of referral fee if you end up closing a deal with that DSO. So their goal, the DSO's goal, is to do a deal in the dark, for you not to have proper representation so that they're not in a competitive environment and they can control the narrative regarding EBITDA and valuation. All too often, we see situations where a client comes to us, they have an offer, they think it's a great offer because it's at 8 times EBITDA, and we start talking to them about EBITDA, and the EBITDA sounds low. I mean, if you're doing $2 million a year and the DSO is telling you your EBITDA is only $300,000, that's far lower than it should be. Let's call a timeout. Let's take a step back. Let's do evaluation. Let's do our own EBITDA analysis, and let's see what your EBITDA actually is from an objective perspective. And if the EBITDA is actually $400,000 or $500,000, that 8 times EBITDA multiple you thought you were receiving is actually a 5 or 6 times EBITDA multiple because they've undershot your EBITDA. So those are the games that DSOs play. I mean, private equity is opportunistic and somewhat predatory. Our goal is to keep them honest and hold their feet to the fire and ensure that by creating competition and optionality, they're going to put their best foot forward and not play games when it comes to EBITDA and it comes to valuation and it comes to deal structure and deal terms. So we've talked about how EBITDA level impacts valuation. Let's talk about how several other factors do. Number of doctors. DSOs would prefer that it's a multi-doctor practice because that bifurcates key man risk among multiple providers, and doctor turnover, key man risk is really their Achilles heel. Number of locations. In an ideal world, you would have multiple locations generating 20 to 25% practice level EBITDA at each location. All too often, though, we see docs with 7 to 10 locations where the EBITDA margin is only 10% because their fixed overhead is so high because they have so much occupancy cost and so much extra staff. I would much rather have a client that has a $5 million revenue single location practice that's running at a 25% EBITDA margin than a $5 million revenue 5 location practice that's running at a 10% EBITDA margin. That single location practice is going to trade for a much higher valuation because EBITDA is the driving force behind valuation, not locations, not doctors. Geography matters. There are some parts of the country that have more demand than others because there's more DSOs interested in that particular geography. The West Coast has been slow to consolidate because of the political, tax, and regulatory environment in that part of the country, but we're finally seeing DSOs begin to consolidate those markets. But you're going to see less demand. The same practice in the Southeast or New England might see 10 offers, whereas if it's in California or Oregon or Washington, it might only see 5 offers. But you're still going to achieve a fantastic valuation. And because so many of the dentists in the country are located on the West Coast, over 25% of the dentists in the country are in the states along the West Coast. We're going to see more and more DSO attention out in those markets over the next few years. That's why we now have a San Diego office. But currently, there are pockets of the country where you see more demand than others. Infrastructure. If you're trying to serve as a platform investment for private equity, you want to hit a 10x multiple and you want to be the initial investment that private equity builds around, you've got to have infrastructure in order for that to be viewed as a scalable business. But infrastructure also comes with a cost and erodes EBITDA. So it could erode valuation. You might get a higher multiple, but a higher multiple on a lower EBITDA number if you're being viewed as a scalable platform for private equity. Payer mix, service mix, just like in the private buyer world, that matters. DSOs are somewhat Medicaid averse. Now, there are a handful of DSOs, especially pedo DSOs, that know the Medicaid game and they're happy with Medicaid. But for the most part, most private equity, most DSOs would prefer that your Medicaid exposure is under 20%, unless you're pediatric, because a lot of pediatric practices just they naturally have a heavy Medicaid component. Most DSOs understand that you're going to have a mix of PPO, fee-for-service patients. Some like capitation, some don't. We don't see a ton of capitation these days, with the exception of very specific geographies, particularly where you've got a large, retirement community, an older population. Doctors post-closing plans. We already talked about the fact that, DSOs are going to be focused on your why. They're going to be focused on your post-closing runway. They're going to want you to agree to stay on for at least 3, if not ideally 5 years post-sale. Controlling that narrative regarding what your window looks like, what your runway looks like, is critically important. We talk to a lot of sellers that are like, I want to retire in 3 years. And I'm like, well, what does retirement mean for you? Does retirement mean that, you're playing golf, fishing, and traveling? That's all you're doing? Or are you going to be more active in your retirement? And, you might be willing to practice part-time, or you might be willing to at least have some sort of, mascot or leadership role in your practice. That's enough. I mean, you can step away chairside 2 to 3 years into a DSO affiliation, keep a vested interest in your practice from an equity perspective, and then, play more of a leadership, more of an operational role ongoing. You don't even have to come to the office every day. But if you tell the DSO up front, I want to retire in 3 years, that's my runway, you're going to take a hit on valuation, and some DSOs are going to leave the table. You're going to take a hit on demand. So controlling that narrative before you start those conversations is critically important. And the last one, this often surprises people. Personality matters. We always tell our clients, let us do the posturing. Let us create the competition. Let us handle the negotiations. You be the most charismatic version of yourself. You focus on clinical autonomy, operational autonomy, your passion for dentistry, and your passion for your practice and your patients. Focus on getting to know the DSOs. Focus on asking the questions that we tell you to ask, and really trying to determine who's the right fit. Don't worry about the economics. We'll worry about the economics. We'll control the narrative regarding EBITDA. We'll make sure that we get the best deal terms. We'll make sure that we ratchet up the valuation. If the DSO falls in love with you, if they believe in you, if they want to partner with you, it will move the needle from a valuation perspective. So personality does matter in these transactions. I think I saw a question come in. All right, so great question here. If you have a multiple doctor practice, are you negotiating differently for the owner versus the associate? If you have a multiple doctor practice, and we're talking about an owner with associate doctors, even if, or you have a situation where you're the majority owner and you've got some minority owner doctors, even if you have a unilateral right to sell your business, do whatever you want with it, if your primary producers are not on board, you've got a problem. Regardless if they have ownership, regardless if they have, any stake in the business, period. If your associates are not willing to sign on with the DSO and go with the flow, you could potentially have a major problem. So we often talk about, have you involved your associates in this conversation? If not, when is the appropriate time? Definitely pre-closing. You don't want to tell them at closing. Now, you also don't want to involve them prematurely because you don't want them to assert themselves and potentially hold you hostage. You don't want to give them the inclination that they have a lot of sway in whether or not you can sell your practice or what valuation you're going to fetch. But it's a delicate subject. So we always need to talk through who are the primary producers, what are their goals in their career, have you offered them ownership? Have there been any conversations about selling them all or a piece of the practice? If so, when and how far along are those conversations? And then we need to be prepared to potentially incentivize them for allowing them to share in the sale. And that could come in a number of different ways. Most DSOs these days have an on-ramp for equity for associates. So they have a way to either gift or sell equity, meaningful equity, to the associate doctors or have them participate in the transaction in some form or fashion. In practices where you have a massive producer that has to go with the flow, in some cases, we've seen our clients agree to gift them equity or share in, the economic windfall of the sale with an associate or minority owner. So we need to talk through that and strategize around when and how we're going to involve minority owners, associates in the conversation, because that is going to be a primary concern of the DSO. Is, are your minority partners, are your associates aware of the sale? How do they feel about it? Do you think they're going to come on board? We're going to want to meet them pre-close and ensure that, they're willing to at least give us the chance, at least give us an opportunity, come to work for us, and hopefully be there long term. A few more questions rolling in, so give me just a second. How are we compensated? Do we get a commission from both parties, buyer and seller? And the answer is no. We're sell-side advisors. We earn our commission from the seller. We solely have a fiduciary responsibility to the seller. So our sole goal is to educate our clients and empower our clients to make good decisions regarding their practice. And then if and when they go to market, help them create as much optionality as possible, find the right fit, and maximize the economics. We represent you and nobody else. Bear with me just a second. What if you had an evaluation on your practice completed by someone else and it meets all the criteria that we're describing? Do you still have to go through the evaluation process with us? And the answer is yes. In the DSO world, we typically charge a nominal fee, $2,500. If you have a multi-location practice, 10 locations, something like that, it might be slightly higher. But our typical fee for evaluation is $2,500. It's credited towards our commission if and when we close on a sale. And we spend a tremendous amount of time going through that process. We don't trust what DSOs put together. We don't trust what other advisors put together. I can tell you that if you give your numbers to 10 different people, they'll come back with 10 different EBITDA figures. It's amazing how inaccurate a lot of the EBITDA analysis that we see are, even from CPAs. The mistake that most people make is they forget to back out doctor compensation. And that's a major component of overhead when we're talking about EBITDA and absentee owner profit. So we do need you to go through our valuation process, not only because we need to peg the EBITDA, but that process is where we get to know you, where we get to know your practice intimately. Because when we go to market and as we start to navigate negotiations and as we start to navigate the diligence process, the quality of earnings process, we need to know your practice backwards and forwards from an economic, from a financial perspective. That's one of the things that really sets our company apart from any other sell-side advisor, from any broker in the industry. Most of us have a finance degree, an accounting degree. We've got a CPA on staff. We're former bankers, former investment bankers. We come at this first from, one, a financial background, but also from an emotional perspective. We understand how impactful this decision is for you. And that's why we've designed the process to make it as educational as possible and as predictable as possible. And our commission on DSO transactions is typically lower than private buyer sales. Private buyer sales can range from anywhere from 8 to typically 9% of the practice valuation payable at close, with that valuation fee credited towards our commission. In the DSO world, our commission ranges from anywhere from 5 to 7.5%, depending on the size of the practice and the complexity of the transaction, how many locations and how many owners. And that $2,500 valuation fee is credited towards our commission at close. I will tell you that on average, a lot of people are like, I've got a large practice, 6% is a lot of money. On average, we move the needle from a valuation perspective by 20% comparative to an unsolicited offer, comparative to what you would earn on your own. So we'll cover our fee 2 to 3x, as well as bring you a lot more optionality, educate you before we go to market so that you're making, pragmatic decisions as to if and when you should sell to a DSO, and then help you find the right fit and find the right deal structure. So the value that we bring far outweighs our fee on a daily basis. and I'm happy to provide as many reviews, as many testimonials, as many references of past clients as you'd like to speak with that can talk to that point. All right, DSO deal structures. So let's talk about the different deal structures that are available in the marketplace. 100% sale with a holdback. This is kind of like the DSO 1.0 structure. This is the structure that really, Heartland and the old school DSOs were using when they began to buy practices. This is, I'm going to buy 100% of your practice. I'm going to pay you, I'm going to set the valuation. I'm going to pay you 70% cash at close. And then I'm going to pay you the other 30% on a seller note, payable in 3 annual installments, contingent upon you staying on for 3 years and the revenue or EBITDA of the practice maintaining where it was when the DSO bought the practice. We don't see this deal structure a lot these days. This is more of an old school deal structure. I mean, occasionally a client that's within a few years of retirement will sell to, they want a finite exit. They want a finite valuation. They want to know when all the dollars are going to be in their pocket. They might gravitate towards this type of structure in one of the larger DSOs, the more old school DSOs that utilize this structure, but very, very rare that we sell a practice under this structure. The next two structures are the most common that we see. 100% sale with a holding company investment. We call this the holdco model. So you're going to sell 100% of your business. You're going to take anywhere from 70 to 80%, typically cash at close. The remaining 20 to 30% of the value of your business, you're going to invest in stock in the holding company of the DSO. So you own equity across the entire platform. You own a little piece of all the practices within that DSO, which is great from a diversification standpoint, but you don't have a lot of control in that scenario because the equity doesn't lie at the practice level. It lies at the holding company level. You typically have the opportunity to sell that equity in full when you hit a recapitalization, a liquidity event. So that's one big advantage, is that the equity is typically liquidated in full at recap. And depending on who the DSO is and where you enter the recap cycle and the size of the DSO, you could see a really favorable return on that equity, somewhere in the range of, 3 to 5x is what a lot of DSOs have been generating over the past 10 years on that holdco investment. But you're not going to see any ongoing, profit distributions from your practice. You've liquidated that in full. The joint venture model, there's a lot of DSOs that are pivoting to this model today, and that's where you're going to sell 60 to 70% of your practice cash at close, and the remaining 30 to 40% of your practice you're going to retain at the practice level. You actually retain that practice level equity. So you're going to receive pro rata EBITDA distributions post-close, depending upon how much equity you retain. So the benefit in this model is that you're going to receive pro rata cash flow distributions on an ongoing basis. You're not giving up 100% of the EBITDA of the business at close. And at a recap event, you're typically able to liquidate this equity in part or in full. Typically in part, you're typically able to sell half of your joint venture equity at a recap event at the DSO's EBITDA multiple, whatever the DSO is trading for. So it's an interesting structure in the sense that at recap, you're going to get the higher multiple the DSO is trading for. Right now, DSOs are selling for 12 to 15 times EBITDA. But that EBITDA multiple is going to apply to your practice level EBITDA. So you control to a large extent what your outcome is going to be at a recap event, because the EBITDA that your payout is predicated upon is the EBITDA of your individual practice, not the EBITDA of the entire organization. So a lot of younger doctors gravitate towards a joint venture model. They like the fact that they're going to have not only their chairside income, but also pro rata ongoing EBITDA distributions post-sale. So they've got a stake in the practice long-term. The hybrid model, that's essentially a combination of a holdco model and a joint venture model, where you're going to take, let's say, 70% cash at close, and then the equity component is going to be bifurcated into holding company equity. Maybe half the equity is holding company equity and half the equity is joint venture equity. So 70% cash at close, 15% holdco equity, 15% joint venture equity. The holdco equity you can exit in full at recap. The joint venture equity you're retaining at the practice level, and seeing ongoing net income distributions. The one thing I'll say about the joint venture model is we've seen a lot of weird stuff recently. Some of them are pure joint venture. You're going to receive your ongoing pro rata EBITDA distributions after the DSO's management fee. In a joint venture model, there's typically always going to be a management fee that's charged to the practice by the DSO. It's going to be an overhead expense that hits the P&L of the practice, and the DSO is sharing in that expense, right? If you're in a 60-40 joint venture structure, DSO owns 60% of the practice, you own 40%. If that management fee hits the P&L, the DSO is essentially paying 60% of it and you're paying 40% of it. We see management fees anywhere from 5% of revenue up to 10% of revenue, depending on who the DSO is. And that plays a major role economically in your post-closing EBITDA distributions. But we've also seen joint venture DSOs, they're going to borrow money to buy the practice, and then we've seen them put that debt that was acquired in order to buy the practice at the practice level, and it hit the P&L and the balance sheet of the practice, which erodes the EBITDA distribution. We've seen joint venture buyers put a ceiling on the EBITDA multiple at recap. Maybe they're going to trade for a 13x, but you're only going to get a 10x multiple. We've seen all kinds of interesting levers that DSOs pull that could potentially erode your economic return. It's our job to call attention to those and then negotiate those through creating a competitive environment. The last one I'll touch on, this is not a legitimate deal structure, and that is the roll-up concept. There are a lot of people out in the marketplace today that are trying to pitch the concept that, hey, doctor, on your own, your practice is worth 6 or 7 times EBITDA. But as part of our co-op, as part of a larger group of practices that we're going to duct tape together and pretend as if they're a DSO, we're going to sell them all simultaneously to the same private equity firm or institutional investor at 10, 11, 12 times EBITDA, at a much higher EBITDA multiple than you're going to trade for on your own. That is a falsehood. The reality is that with rising interest rates, with capital constraints, the dumb money has left the marketplace. Duct taping together a bunch of unaffiliated practices and trying to pretend that you've got a fully integrated platform and command a higher multiple from a DSO buyer is a non-starter. DSOs are not stupid. They're not going to pay a higher multiple for a bunch of unaffiliated practices. The reason that people are pitching this concept is because they're trying to create a captive audience, and they're going to charge you a fee typically to join the group. They're going to charge you administrative fees along the way for administrative services. And then if and when they bring you this unicorn deal, they're going to charge you some crazy transaction fee. In reality, that deal's never going to come, but they're going to live on the management fees that they charge you ongoing. They're going to live on the initiation fee that they charge you to join the group. And then at some point, after they've, bled you dry in fees, they're going to try to convince you that, hey, unfortunately, the roll-up concept is not going to come to fruition, but we've got 2 DSOs who'd like to bid on your practice, and they're going to bid, 7 times EBITDA. You should sell to them. Well, you could have sold on your own or through somebody like us for 7 or 7.5 times EBITDA. What's the point in paying all of those fees and betting on the come and hoping that some unicorn deal is going to happen? It's death by a million cuts. It's never going to happen. I highly encourage you not to fall for these gimmicks and not to believe what these charlatans are pitching. It only is set up to benefit them. It's not set up to benefit you. So I'll get off my soapbox about that. Are you more appealing to a DSO if you're willing to stay on for more than 5 years? That's a question that just came through. The short answer is yes. I mean, DSOs love partnering with younger doctors, right? They love sustainability and longevity. So the younger you are, the more runway you have, they look at that as being a less risky investment. And those practices will typically have more demand and potentially trade for a slightly higher multiple. So youth does move the needle to some degree. Now, at the same time, if you are young, you need to weigh what is your runway, what are the economic implications of a sale on a 5-year window, 10-year window. You don't want to factor in 3-4 recap events. And you'll see DSOs out there selling people on the fact that, hey, we're going to hit 4 recap events. And the compounding impact of that is that, the investment that you make in our DSO is going to, hit 30x, over the next 15 years. We like to factor in 1, maybe 2 recapitalization events when we run our economic models. And I think it's important to mention at this stage that not only during the valuation process do we quantify your EBITDA, do we educate you regarding what your EBITDA is and what your practice would trade for in the open market, but we're also going to run an economic cash flow model that will show you, based on your EBITDA, based on the valuation we placed on your practice, what does this look like in a 5-year window on different deal structures, the holding company model, the joint venture model, the hybrid model, so that you can get a feel for how does each of these deal structures function? What are the economic implications of each deal structure? What are the economic implications of one recap versus multiple recaps, of hitting a recap at 10x versus 15x? We can model that all out for you before we ever go to market to quantify the financial implications so that you can make an educated decision as to whether this makes sense to you financially first. And then we've got to talk about the emotional component. We've got to talk about the why. We've got to talk about the intangibles. Outside of economics, what are the other compelling reasons that you're looking to sell your practice? So let's talk just briefly about the top 5 mistakes that dentists make in a DSO transaction. We've already hit on some of these. The biggest mistake that we see people make is responding to an unsolicited offer, the failure to create competition. DSOs would prefer that you don't have representation, that you don't control the narrative regarding EBITDA, that they're not bidding alongside other DSOs. They prefer to do a deal in the dark and for them to basically have a proprietary lead where they can shepherd you through the process and ultimately, underpay for your practice and have you agree to less than ideal terms. Selling to the wrong DSO. Again, you've got to start with why. Why is going to define who you sell to, what you're looking for in regards to a fit. If you're selling because you want administrative support, then you better make damn sure that you sell to a DSO that has infrastructure that can actually support your practice from an administrative perspective. And they're all different. Some DSOs have very little infrastructure. They offer very little support, while others have 300 employees that sit in a corporate HQ every day and are there to support you with your needs and your wants, and everything in between. So you've got to start with why. That's going to dictate who you sell to at the end of the day. Not asking the right questions. There are a million questions that you should be asking as you start to talk to DSOs. We believe that diligence is a two-way street. So you need to be asking as many questions as the DSOs are asking of you. You're going to give them a tremendous amount of data, a tremendous amount of financial information. We give our clients a list of questions to ask during initial calls and interviews with DSOs. We want you to do diligence. We want you to ask the questions directly to them and gauge their answers and figure out how that fits into your why. We're also going to, once we narrow the field to probably our top, 2 or 3 buyers, we're going to want you to speak with doctors that have partnered with that DSO. Talk to doctors that have partnered with them for long-term versus short-term. What's been good, what's been bad. So I think it's really, really important that you treat diligence as a two-way street and you know the right questions to ask. Failure to obtain proper representation. Look, your practice is one of your most valuable assets. And this is also a very emotional and financially impactful decision. You got to make sure that you've got a stellar team. You need a rock star team behind you. You need a sell-side advisor. You need somebody like us. You need to have a good dental attorney, somebody that's well-versed in DSO transactions. And you need to have your CPA weigh in on the allocations and the tax implications of the sale and make sure that you understand, what are the tax implications going to be? How can we mitigate those tax implications? How can we utilize structure? How can we utilize alternative investments in order to ensure that, your tax burden is as small as possible? And then falling for a gimmick. Stay away from those roll-up concepts that I talked about earlier. Stay away from buy-side advisors. Question just came in. Is there a benefit to partnering with a DSO if you have an entrepreneurial mindset? You're not looking to exit your business. You're looking to ramp your business up. And the short answer is yes. A lot of young doctors that are entrepreneurial, that want to build a multi-site, emerging DSO, they'll partner with the DSO for a couple of different reasons. They want administrative support so that it's not all on them to grow a multi-location practice, and they want access to capital. They want, you're going to max out with traditional banks, conventional lenders, around 3 million, 4 million in loan exposure. I mean, you can only buy a couple of large practices and a couple of pieces of real estate at that level of debt. So oftentimes, young entrepreneurial doctors will partner with the DSO early in the growth of their own, call it sub DSO, to get access to capital and access to administrative support. So we've seen a lot of entrepreneurs use a DSO affiliation or private equity partner to take their practice to the next level. A couple more questions came in. The DSOs typically want all your financials. What type of line of sight do you have into the financials of the DSO? I will tell you that most DSOs will share some financial information with you, whether that be a balance sheet, a P&L, what have you. But there's not a clear line of sight into the financial fortitude of most DSOs. What you really have to gauge is the pedigree of their management team, the pedigree of their financial partner. Has that particular private equity firm invested in a DSO before, or other medical verticals, and what has been the success rate? What has been the return on those investments? Has that DSO hit a recap before? Have they hit multiple recaps? When did those occur? And what were the outcomes, of those recapitalization events? So it is hard to get a good line of sight into the financial health of these DSOs. But what I'll tell you is we interact with DSOs on a daily basis. That is the sandbox that we play in on a daily basis. It's relatively easy for us to judge, if I were offered the opportunity to invest in equity in that DSO, who I would write a check to and who I wouldn't. And that's how we vet who we put at the table with our clients. If I wouldn't be willing to invest my money in them, I can't, with a straight face, ask you to roll or retain equity in a DSO affiliation with that particular DSO. So we spend an inordinate amount of time vetting DSOs before we ever allow them to sit down and bid on one of our clients' practices. There are over 400 DSOs operating across the country. We work regularly with about 50 to 60. So depending on your geography, depending on the unique attributes of your practice, and depending on your why, we'll typically take your practice to 10 to 15 of the top DSOs that we think would be a fit for that particular opportunity. We don't shop it to 300-400 DSOs and leave you to vet, who are the good and bad players. We already make that distinction before we narrow the field and put them at the table with our clients. So question came in. Do DSOs really offer the doctor autonomy, both clinically and operationally? And I will say that most DSOs, at least the ones that we work with, again, we don't work with all DSOs for a reason. We either don't believe they're financially sound, or we don't really believe that they offer the autonomy that they're promising. Or we've heard horror stories about doctors that have partnered with those DSOs, not our clients, but we go to all the DSO meetings. We talk to, on average, probably 15 to 20 doctors a day. We hear the horror stories, the stories that you're not going to see on the internet, that are not going to be publicized on Dental Town or in Google reviews. So we've got a lot of intel that you would not have on your own, and we use that intel to vet these DSOs. DSOs that we work with offer really pure clinical autonomy. From an operational perspective, the levels of autonomy differ, but your why is also going to dictate who you partner with and how much operational autonomy they offer. If you tell me, hey, Brandon, I don't want to run this business anymore, I don't need operational autonomy because I don't want to deal with the administrative side of the business, partner me with the DSOs, show me offers from DSOs that have robust operational infrastructure. Those DSOs might have a little bit of a heavier hand from a day-to-day operational perspective because that's what you're asking for. If you say, hey, Brandon, this is purely economic for me, I want to partner with a DSO that offers pure clinical and operational autonomy. I don't want them to be involved in my business on a day-to-day basis at all. Okay, then let's go to DSOs that maybe don't have a lot of infrastructure and are not going to weigh in on a daily basis from an operational perspective. But time and time again, you can talk to our references. The doctors have a tremendous amount of autonomy in this iteration of DSOs. There are some larger DSOs out there that offer less autonomy. Very rare that our client will ask or end up selecting one of those DSOs to sell to. So we talk a lot about autonomy, both clinically and operationally. We talk about infrastructure. We talk about economics as we introduce you to buyers and we start to move through the vetting process. So there's a vetting process that occurs before we ever introduce you to a buyer. We only want to introduce you to the best of the best. And then there's a vetting process that occurs at the time that you set up initial Zoom calls and meetings with buyers where you're going to ask a lot of questions to identify if that particular buyer is positioned to help you accomplish your why. Let's see if I've got any other questions. Do you work with large practices in the Northeast? Absolutely. New England is a fantastic market. We do a lot of business there. And we've seen sky-high multiples in that market as of recent. Most recently, we sold a practice in the Pennsylvania market outside of Philly that commanded an 8.5 times EBITDA multiple. And that was a single site practice with EBITDA of about $1 million. So New England's a great market. Love working with big practices up in the New England area. So I really appreciate you spending the past, wow, time has flown by. It's been almost 2 hours, but I really appreciate you spending the last couple of hours with me. I hope you learned a lot, and I am always available to answer questions. I'm here as a resource. My first job is to educate and empower you to make a good decision with your practice, whether that's selling to a private buyer, selling to a DSO or private equity, whether that's selling today or selling 5 years from now. I encourage you to reach out, shoot me a text, send me an email, go to our website, check out the DSO transactions landing page on our website. It's got a lot of webinars, podcasts just like this, a lot of articles that you can read to get educated about this ecosystem and what's entailed in selling to a private buyer versus selling to a DSO. So thank you so much for your time. I will send everybody an email with a link to this presentation, and hope you have a great night. Take care.